Welcome to another episode of Bar Charts Market on Close. I'm your host, John Rowland, Bar Charts Senior Market Strategist. And it looks like the market's going to settle on a very strong note, and maybe what we have seen in our past few weeks of a correction is now moving forward. Crude oil is flirting with $80, but I think I could make a case for it to get closer to 100 before the year's end. Michael Saylor, evil genius or madman on a path of destruction? And finally, Wall Street is finally acting like Wall Street. All this plus your questions, and to help me with today's session is my co-host Thomas. Hello, Thomas.
Hello, John. Good morning to me because I'm
Yes,
still in
good morning.
Thailand. So it's a beautiful 3:30 in the morning here, John. Good afternoon to you and all of our viewers. How are you doing?
I'm doing well, but I know that you're in a warm place, so don't complain, brother, because we're about to hit the polar vortex through most of the United States. I think I saw Chicago next week could see numbers in the minus teens for a high.
That's what I like to hear, John, because this is my strategy of avoiding Chicago during the brutal months of January and February. But hopefully everybody stays safe out there. John, we've got a great show, but before we jump in, I just want to give a quick reminder for everybody watching directly on our website. If you want to ask a question, just click ask a question at the top right. You'll see it in the orange color. And then for those of you watching on YouTube, just go ahead and ask those questions directly in the chat, and we will get to as many as possible. All right, so let's jump in here, John. So the last few shows, we've discussed the state of the markets and the possibility that a change of character could have been developing in the market. And the markets have, for the most part, been really choppy, John. Since December, we've had big down days, big up days. Felt like a roller coaster with the bulls declaring victory one day, and then the very next day, the bears saying, aha, nope, you're wrong. We're in control here. But one thing I mentioned earlier this week, John, was that the S&P 500 closed just below its 50-day moving average, and I was hoping that it would get above, preferably with a weekly close. And the good news, John, is it seems as of now it's going to do that. So, John, here's the question for you. Do you have your bottle of champagne ready to pop, or is it still on ice?
No, I would say going into the beginning of this week, I really thought that the market was more in still in that limbo, that kind of that psycho move. Like you said, one day down, one day up. You get two different economic reports that basically say the same thing, and the market acts in total opposite. But again, this is what you were kind of talking about, and this is what we were looking at, this change in character, where we were seeing the market was kind of feeling like it was rolling over. And what we were seeing was lower lows and lower highs, right? Not necessarily a downtrend, but certainly a potential correction. And what we were saying is that, that in order for us to have a downtrend, or in order for us to break this uptrend, this long-term secular bull, we probably want to start seeing us break some structure. Now, we talked about, this 5,850 level as a neckline of maybe what could have been a head and shoulders formation, and that there was a void of price and in this gap here, and that we needed to hold this structure, right? We didn't want to break this structure. And I love gap trading, Thomas. We talk about gaps all the time, and boy, look at this. I mean, this is just remarkable how the market fell into that void and literally filled the gap, and boom, bounced straight out. So this is a very constructive bottom in terms of filling the gap. Big up day after touching, rejecting price, and then, gap up and gap up again. So this is really good. And now what you said was, that 50-day moving average. So let me change this a little bit here. I'm going to put up my template. Let me make this a little bit better for us to see. And let's go to a little bit wider time frame. And so there you can see the 50-day moving average this morning was around 592 and 593, excuse me, 62, 63. I drew a little red line here right there. And you can see that it looks like we are not only through it, but certainly above it. And I also have this little down sloping trend line. It feels like we're closing right on it or a little bit above it. Now let's go to a weekly chart. And this is really where we kind of want to do our big picture analysis. And so, yeah, we were seeing a series of weekly closes or weekly candles of lower highs and lower lows. But boy, what did we get this week? We got a nice big green candle, big green engulfing candle. And you can kind of see that, let's make this a little bit bigger here, right? Closed above that 50-day moving average, which was that line I drew at the daily. And it looks like right now we're going to close above 6,000. So I think all of these things, Thomas, are very, very constructive for the market. And, one day or 1 week does not necessarily make a trend. Certainly the characteristics of what we had thought was going to happen are at risk of changing back to more of a bull market. So, we still need to see a follow through. So I think we're setting up for next week. It's a short week next week. But let's see. We'll see what happens next week. If we can get a continuation of this, then I think, then it's Katie through the barn door, so to speak, right?
Yeah, and I think if the market does go on to higher levels, John, I think we'll look back at this period as being a much needed, healthy consolidation period, a bit of a breather because the market was getting quite heated. So I think it's what we're seeing right now is pretty healthy price action, I think, John.
Yeah, what we probably want to look for, and I think as we go through today's show, we'll see that, it's the health of the market is really spread a lot along multiple sectors. Some sectors that have been underperforming and some of the sectors that have been leading, but the leadership is not really confined to those, those Mag 7s or those 5 or 6 stocks that we've been looking at for the last year and a half.
All right. So besides the equity market, John, the other big sort of topic of discussion this week is crude oil. Now, crude oil for a while had been really quiet, been falling off a cliff. It has rebounded, John, in a strong way. It jumped to its highest price since August. But here's the question, John. Is this just going to be a minor sort of bump up for crude, or are we looking at the possibility of getting back to those $100 price levels that, if you're not an energy trader, you're pretty fearful of seeing crude get back to $100?
Certainly at the price pump, right? So yeah. Crude oil prices have been rallying on the back of the sanctions that have been placed on Russia, and the likelihood again that we'll see some sanctions against Iran and Venezuela with the Trump administration. Also, I think crude oil recent has been rallying on the with sympathy with the rise in rates. It's kind of this inflationary aspect. And there's also been a lot of speculation of support of Chinese economic data. And I know that we got some good economic data out of China just recently as well. So, yeah, I think in the short run, Thomas, the market is certainly have had a nice move. You can see that down here we had this little area of consolidation where, we stopped making newer lows and we found looks like a very strong bottom. And, the market kind of coiled into like this little box here or this little pendant and finally broke out. Now, depending on how you draw your trend line or how you look at this over, a longer period of time, I think we could make a case for, that we are testing the upper bounds of this trend line, or maybe we even have potentially have broken it. So what's interesting to me, Thomas, is this is all has happened in the light of a strong dollar. And usually what we see is that, the dollar can be a headwind. So this is kind of interesting to me that crude oil was able to rally on the back of a strong dollar. Now, if the sanctions come through and we see some resolutions to some of these conflicts, especially the Ukraine-Russia one, then I think that will become a peace dividend for the energy market. In other words, I think then you'll see crude oil prices retreat. But there was an interesting white paper that came out this week from Wood Mackenzie, and basically what this white paper said was that the energy transformation or transfer from old hydrocarbon to new renewables is being delayed because of the cost of capital. And so that, we're going to still need to rely on, old fashioned oil and gas. And so when we look at the market from that lens, what I think is really kind of interesting is if I go to, for instance, Schlumberger, right? So here's a company that, is in the oil service sector. And you can see that, this stock has been on a downslide as well with the price of crude. Remember, only a couple of years ago, they were basically told that, hey, you're going out of business because you're a dinosaur and, we're never going to need oil ever again. And all of a sudden, boom, dynamics of starting to change. And their earnings came out this week and they did very, very well in their earnings. And look at this one in terms of our moving averages. Yeah, I think, look, we got a gap above our 50-day. We recaptured the 50. We got above the gap above the 100-day, and we're now bouncing up against a downsloping 200-day. So, that's kind of encouraging for me in terms of there might be some more potential moving forward. But if we look at the game plan of majors, let's say ExxonMobil or ConocoPhillips, their business model recently has been, in terms of production, is just to maintain production, not really do any more CapEx in it. And that's because, it's costs a lot more to drill a well these days, for the parts, the crews, the labors, and the financing. Now, the Trump administration says they want to drill, baby, drill. But the majors are telling them, hey, you know what? We're not going to drill, baby, drill unless we can have supportive prices. So in other words, what they're saying is we're not going to drill or increase production until we see higher prices. In other words, they want higher prices in order to increase production. And that is not going to happen. But we are seeing increase in incremental demand. So I do believe that there is a potential for crude oil prices to go higher based just on that business model dynamics. Now, for the majors, though, it might be easier for them, instead of to pay for new production, and just buy old production. Or in other words, I think what we're going to see in the oil patch, and what we have been seeing, is a lot of M&A. And so here, I just want to kind of point this out to you. Here is on our top performing stocks, top performing industries. And, gosh, look at this. Of the 10 industry groups that are in the top performing right now, this is over a 1 month period, by the way. We can change this. I'll show this in a second. I'll change it another. But it's energies, exploration, production, oil services, right? So, Schlumberger is in that oil services. We could go in there in the oil services sector, and you probably heard of, Schlumberger, Halliburton, right? Look at Baker Hughes here, right? Let's go to a chart of Baker Hughes. Schlumberger and Halliburton are kind of your legacy or your behemoths, but look at Baker Hughes here. I think is kind of interesting. This stock has done very well, and it's kind of, if you look at this in terms of a big picture, let's change this to a weekly. It has been in this kind of this wedge pattern for a while, and it certainly looks like to me it's breaking out. So what I'm going to be looking for, Thomas, is not necessarily oil services, but certainly I want to see strength in them. That's telling me that people are actually putting money into producing new wells. What I want to do is I want to watch in the oil production, exploration and production segment. And what I want to see is, are we going to see some M&A in there? Do we see the majors buying any one of these companies? And these companies all are what I would say smaller cap, mid cap companies that own production in some very unique areas. And the couple now, this is not a recommendation. I don't know if this is going to. I'm not saying these are buy takeover candidates, but if you see like a Devon Energy or an APA Corp, right? These stocks are undervalued compared to their peers, and so they might be a buying opportunity. So that's kind of what I'm watching for. Is do we see some increased M&A from our large major players, and will a weaker dollar, kind of spur the next wave of oil prices? Do we get to 100? I don't think in the next week, next 6 weeks, maybe even in the next 6 months. But I think this is a secular change in a market that had been really kind of been dumped on over the past couple of years because of this green energy movement. And that seems to be delayed. And so I think what we're seeing here is a rebound in the energy sector.
All right, John. So let's jump from that to one of your favorite stocks, and that is MicroStrategy. Now, our regular viewers, they know you love MicroStrategy, you love Michael Saylor, you love Bitcoin. In fact, I think you were invited to Michael Saylor's New Year's Eve party aboard his yacht, John. So
how'd you know that, right?
I saw a picture. A picture started floating out there, John. I won't share too many details about it because we don't want that getting out. But I hope you had fun. But here's the thing, John. MicroStrategy has been the talk of the town for a while, and they have a crucially important vote coming up on Tuesday, and that is where the shareholders will decide whether to approve the new plan, which is to increase the authorized shares from 330 million to 10.3 billion, John. That's a huge, monstrous increase. Now, I did see that analysts are expecting this to get passed easily, John. Especially because Michael Saylor owns 47% of the voting power. So that's pretty much a shoo-in gimme vote. But John, here's the question. Is Michael Saylor playing 4D chess and he just is able to see 3 and 4 moves ahead of what we are able to determine? Or is this going to end up in tears for MicroStrategy shareholders?
Brother, I don't know. I think, it's a financial experiment that is somewhere between market behavior and price arbitrage. And, if you're going to dilute your stock by 30x, I mean, how can that not devalue the shares of the stock, right? Obviously the price is going to go down, but that's because of the new devaluation. But, you're expecting the stock price to go up. This is this 4D chess, as you're saying, is you're expecting it because of the rise of, another asset, right? So I think this is an experiment that, I don't have a dog in this fight, but I certainly am going to get my popcorn and watch this. I want to see this play out. I want to see exactly what it happens. But think about this. You're selling shares of your stock to create cash flow to buy more Bitcoin in order to drive your stock price up so you can sell more of it so you can buy more Bitcoin, right? Right? Think about that. That's like Exxon going and selling shares of their stock to buy oil. Where they do the opposite, right? They sell oil so they can buy shares of their stock. So I don't know how this is going to play out, but to me, the assumption is that Bitcoin is going to go up. Well, what happens if Bitcoin doesn't go up? Well, what happens if something upsets the Bitcoin apple cart, right? I mean, what if we get another crypto that replaces it, or that there's an adoption of a crypto that is better than Bitcoin? I don't know. I mean, I'm just making up an idea. Well, that would, drive Bitcoin prices down. Now, I know you've told me that there's this Bitcoin cycle and that somewhere between now and the end of this coming year, we're going to be in the down cycle. So, I mean, how do you justify this if Bitcoin prices start falling, right?
Well, it's a great question, John. And, my expectation is that this year is going to be very good for Bitcoin. I've said that for the last 3 years. I've always pointed to 2025 as being a great year. 2026 should, in theory, be a not so good year if the 4-year cycle continues to hold. And here's my concern, John. In these bear markets, we see Bitcoin historically drop about 75 to 90%. Okay. And what happens if an over-leveraged Bitcoin proxy like MicroStrategy starts to collapse at the same time as Bitcoin? Could that exacerbate, a sell-off in Bitcoin and really start to cause some concern among people involved in that space?
Yeah, and the other thing I saw today was that Coinbase is going to allow loans based on Bitcoin collateral. Well, that's Bitcoin on margin, right? Or the cash on margin. I mean, and the way that those loans were designed is that it wasn't going to be an accrued interest. As if your collateral fell below a certain level, they had the right to liquidate your Bitcoins to pay your debt, right? So, right, that kind of would be like a snowball effect. But I just want to kind of point this out, just for shits and giggles here. So here is next week's weekly expiration in MicroStrategy. And what I thought was really fascinating, because my take would be that there's got to be somebody who's betting on the downside. And if you look at the volume today, or you look at the open interest that has been created, there's not really anything that really kind of stands out to me as I go down, scroll down. But as we get closer to, current price in MicroStrategy, I see it like somebody large open interest and volume today at the $500 level. So obviously somebody is making this big bet or this big idea that this is going to be very beneficial, not only to MicroStrategy, but probably is beneficial to Bitcoin as well, right?
Yeah. I know you said you don't have a dog in the fight. I obviously do. People know that. I'm very invested in the space. I'm not invested in MicroStrategy, but John, as somebody who's been in Bitcoin for 8 years now, I recognize that Michael Saylor has done a lot for the space. He's helped push it forward in a way that really I don't think anybody else has. I'm cheering for the guy. Like I really want this guy to succeed. He's had to take a lot of crap from people, John. He's had to listen to a lot of crap, and right now he's getting the last laugh. And I kind of, I'm rooting for the guy. He's been an underdog for a long time, and he's done well for himself. So.
Yeah, but it reminds me like, the drug dealer that hits his own stash, or there's an old story about the guy who, thinks a stock is cheap and keeps buying it, and he drives it all the way up to $100. And then he calls his broker and says, hey, you know what? My stock is at $100. I want you to sell all the shares. And the stockbroker goes, well, to who? You're the one who was buying it all the way up here. So I think there's a cautionary tale somewhere in there. That's why I really want to see this thing play out. So I don't want to spend any more time on this one, Tom. Let's just move on.
Yep. All right. So let's move from new age finance, John, to old age finance and talk about financial stocks, bank stocks. John, they were a top performer in 2024, and now they're kicking off earnings season. And so far, the numbers are looking good. Now, historically, when you see banks, when you see finance stocks really kind of kicking it up a notch and really going into full gear, that can often precede the next great bull run in stocks, John. Do you think we're bearing witness to something like that right now?
It certainly feels that, right? I mean, like you said, an old school market cycles, usually financials and technologies are the ones that lead away. Now, if we look at what happened coming into 24 last year, financials were one of the underperforming sectors coming into 24, and we did see a nice run in the financials. So, through most of 2024, let me go to a chart here. Let's go to XLF. But if we looked in that sector, right, and what were the ones that were doing really, really well, what you would have found is that most of them were like consumer services type financials, like for instance, credit cards or debt servicing. Like there's like a company called Dave that's done really well. Mr. Cooper, I can think of a couple other ones. And also your insurance companies and those types of finance, where the Wall Street banks were doing decent or kept up with the market, but they were really kind of underperforming the other stocks in their sector. So you can kind of see how, it was a good year for the financials. But what I noticed in the last couple weeks, or at least the last couple of days, if I go to, let's say, here's financials here. This is the ETF. And if we go into performance and then we sort this by, alpha, there's the credit cards, right? Discover, American Express, right? But look, here's our Wall Streeters, right? Morgan Stanley, Goldman Sachs, Wells Fargo, Citi, right? JP Morgan Chase. So let's go to those charts. And this is really what I was kind of saying to you in our production meeting is, this is the one that's been doing really well all throughout the year. Here's American Express, right? I mean, just nice and steady, right? Financials. But look at what's going on here with Goldman Sachs, right? Kind of was lagging the S&P here. This is a comparative index with the S&P, kind of lagging back and forth. But now, wow, big breakout right out of this area of consolidation. Again, very, very looking similar. If you think about this, this looks very similar to what we saw in the S&P, right? This kind of this sideways to downtrending held a level of support. Now, this didn't fill the gap, but here now we're getting a breakout above. So is this a sign that this is the leadership that we needed other than technology? Here's JP Morgan, right? Look at that. So, yeah, I think this is a really good sign that we're going to see a continuation in the broader indexes, but in this space as well, when these types of stocks, or this group of stocks just does really well, it really takes leadership and it kind of drags everybody along with it. So, yeah, I think this is very positive.
All right. Well, fingers crossed for that, John. I don't own any banks. I don't own any finance, but knowing that they can precede a strong market makes me root for them. Makes me really pay attention to these earnings numbers that are coming out. So
this is the only caveat that I really think. If you're in a typical market cycle, old school market cycle, financials are usually found at the bottom of the market. Now here we are at the top of the market, but maybe that's because we just had a correction. But they also, look at, it's during a recessionary period, and certainly a lot of folks say we're not in a recession. Maybe we had a rotating recession underneath the surface. So it's a little outside of the box, but it's certainly a sign of strength in the market.
All right. So, John, we're a couple minutes before 3, but you want to go ahead and get the Q&A started?
Yeah, let's do it.
All right. So earlier this week, John, or actually this was last week, nat gas has been really strong of late, John, and it's soared to its highest price since December of 2022. That's how big of a jump we've seen. So we got a question asking if nat gas could soar even higher, potentially to a price target of $5, John, which is be a huge bump based on this chart. Do you think that's in the realm of possibility?
Yeah, I do. I really do. And again, let's go back to this ideal of energies and the delay of green energy as well. Crude oil is really kind of that lubricant to the engines of economic growth, right? I mean, trucks and planes and trains and all that kind of stuff. But really, natural gas is the one that is going to be part of that power, the electricity. So I think the mega trend for natural gas is really, really strong. And after multiple years of a downtrend, we're starting to see, natural gas prices rally. Now, on top of that, we've had 2 or 3 weather events here in the States, and we're about to get another one. Now, the natural gas market is always looking forward in terms of weather, about 15 days. But from my experience is when you get a couple of these impulses where we get a lot of cold weather, you usually get more throughout the year. And there is a phenomenon that happens when you get really super cold temperatures, what is called freeze off, which literally the wells that they're producing natural gas freezes, and that stymies production. So demand is there every day. And if you cut back production, even just for a week or two, that will change in the balance of the market. Plus, if we look at Europe, remember I told you to look, if you're going to watch natural gas prices, watch the European market under energies here. You can see energy commodities, the TTF. Watch that one as well. And that will give you clues to where natural gas prices here domestically will go. And you can see on a weekly basis, this is a really nice, strong uptrend. And inventories are falling at a very rapid rate in Europe. And so if we go back to, let's say, historical levels, and this is what's going to happen over the next 3 weeks, is we're going to see large inventory draws. This is the EIA, which is the Energy Information Administration. And here's a little chart that shows you where inventories are here in the States based on a 5-year average. The shaded area is the 5-year average. So you can see we have been on the higher end of it. That's why we had kind of depressing prices for the last couple of years. But the projections after the next 3 weeks of the draws that we're going to get, that is going to put us on a path where we're going to be, by the time the end of the winter, we're going to be at the low end of the 5-year average for storage. And we have to go back to like 2022, 2021 to where we could see those similar inventory levels. And if we do that for natural gas, and we look at that in terms of where that was, and I'm going to go to the weekly 2022-23. That would be in this. And this is where natural gas prices were above $6 to $7. So I think there's a good, strong case. Continued weather, strong demand from European markets, and also this green energy delay, that this is, again, more of a secular story, in a change in an industry that was kind of being battened down or beaten down because of a narrative, and now it's a realization that we can't make that transfer until we get a more developed energy grid, and natural gas is going to take us there. So yeah, I think short run probably a little bit of a sideways or maybe a pullback, but I wouldn't be surprised by sometime late summer we might be bouncing up against the $5 mark as well.
So, John, we got a follow-up question. One of our users is beginning to take a look at nat gas. They want to start trading nat gas, and they want your advice because they know you've traded nat gas for a long time. How should they start? What should they look at? They're asking if they should focus on weather reports or storage and production reports, and if that's important, where would they go to find that?
Yeah, well, I would definitely have a very reliable weather source. There is a guy that I've been following for a long time. It's called Mike's Weather Page, but if you Google it, his actual Google page or web page is Spaghetti Models. I know that sounds kind of weird, but that's what you can look at. And what you want to do is you want to have a website that's going to get you access to what is called the models, the GFS and the European models. Now, the natural gas market is always looking about 10 to 15 days out. Now, weather prediction has gotten a lot more accurate in the last few years. But to tell you if it's going to rain or snow 10 to 15 days out, not really. But they can look at temperature. So they're always looking at about 15 days out. So that would be one thing. So yes, weather is definitely a part of that. In the wintertime, obviously cold weather. And there's something called degree days, how much energy we're going to use to heat our home. So you have heat degree days, and then in the summer we have cooling degree days when it gets super hot. So I would look at that. The other thing I would be looking at is, again, inventories, EIA. That is definitely a place to. But, price alone, I think, is a really good positive indicator, right? Just watch what natural gas prices are doing and what are those trends. So I think those three things, right? Watch natural gas, let's say, on a weekly price, look at weather about 15 days out, and then keep an eye on to see where we are in those inventories. Those would be what I would teach a junior natural gas trader to get started.
All right, great advice there, John. John, you are famous, world famous, in fact, for saying nothing good ever happens below the 200-day moving average. So the question is, does that motto also apply to ETFs like TLT and IEF, which otherwise than that might be exhibiting some positive momentum or positive indicators? What do you think?
Yeah, I mean, that's kind of one of my always my my kind of my go-to, right? I'd say that, I'm not really one to invest in a market unless it's above its 200-day. That's kind of that adage. So let me just kind of clean this up a little bit here. So the question is, well, why do we invest, right? Why do we invest? Well, I think there's two reasons why we invest: for potential income and capital appreciation, right? So if you're going to invest in an ETF that is based on an interest rate, well, then you want to make sure that you get some kind of interest rate payout, or in this case, right, a dividend. So we can look and see that here's the 7-year note. You get about a 3.5% dividend, right? So that's your income. And then we want capital appreciation. So how does the market give us capital appreciation? Will rise in prices. Well, why would an interest rate ETF rise in price? Well, that would be the anticipation that interest rates are going to fall, right? And that then these prices will rise. But if we're looking at a 200-day moving average, that is telling us that capital appreciation is not existing, right? The market is going lower. So could I buy a stock or an ETF or an interest rate bearing note based on the thought that I think that there's going to be capital appreciation or a momentum in that market? Yeah, I think that would be possible. Am I going to invest in it? In other words, hold it for a long period of time? Probably not. My idea might be that there might be some momentum to the upside to it. But again, if I'm below the 200-day moving average, there might be some constraints to that momentum. And so momentum is really telling me if I'm buying a non-appreciating asset, then what I'm really doing is contra trend trading. In other words, I'm buying an asset that has been falling. So I'm looking at what is called a mean reversion trade. And so on a mean reversion trade, we can look at things like Bollinger Bands. And yeah, we did get oversold on some of these treasury ETFs, but we're now back to the mean, right? We're back to the mean, or maybe even to the, getting close to the outer band on the other side, which would be a clear sign that we probably want to sell this one. But if we go back to our chart and we look at the 200-day moving average again, right, we're still well below that 200-day moving average. So can I play momentum on a mean reversion? Yes. Why do we invest? Income and capital appreciation. So I think there's a lesson in there, Thomas. I don't know if I made it clear enough, but I certainly think, and as far as I'm concerned, if I'm investing, I want to make sure that I have an appreciating asset, not a depreciating asset.
John, is there a chart pattern or maybe something else, John, that you would use or look when you want to sell on options strangle?
I can't think of one off of hand, but if we go into bar chart screeners, I did a presentation for some options traders, and this was a question that came up. And we do have a screener here. It's called lateral price range. A lot of these stocks that you're going to find in here are really on death's door. But what you will find occasionally is, let's see if I can find a good example, is this is really kind of telling you that a market is making lower highs and higher lows. In other words, in some kind of a consolidation. So let's kind of just look through here. So yeah, I mean, this was not a bad one, right? So here would be a good kind of strangle market, right? You'd look to do some kind of strangle around 270 and 220. And, how long has the stock been in that range? Well, I mean, you can go back until July. That's 6 months it's been in that range. So this might be a good candidate for a strangle. So I would look at that screener, which is, again, I'll show you where that is. Investment, bar chart screeners, lateral price range. Look for those that are kind of like, stuck in a range, right?
This is a great question. This is actually from Jim Van Meerden, John. So Jim's question is, if the long-term plan is to own Bitcoin, should you dollar cost average so that your cost basis is below the average over time? Now, John, I've talked about this before. I have said that the best strategy for most people is to DCA into Bitcoin. But the thing with the DCA strategy, John, is you have to be disciplined with it, okay? So you have to decide, okay, I'm going to do it once a week or once a month or once a day, and you have to be consistent. That you shouldn't be cherry picking, because once you start cherry picking when to DCA, you can get into this game of choosing the wrong times, and then you're sort of hurting yourself, John.
I mean, I don't have anything to add to that. I think if you're going to do a dollar cost average, you just have to, sometimes, actually you want prices to come down to you, right? Because now you're getting more value for your bang for your buck. So yeah, you have to be consistent. You have to do it on whatever that schedule is, and if that is your strategy. But at some point, if you're dollar cost averaging and it keeps going against you and keeps going against you and keeps going against you, and the return or the loss that you have accrued based on your dollar cost averaging is greater than you initially wanted to lose, then that can be a problem in terms of trading, I think.
Yeah, and I think, for me, John, I've talked about this 4-year cycle before. My plan, my goal is to buy during that year of the bear market when you see Bitcoin tumble 50% plus. That's when your largest purchases, in my opinion, should happen with Bitcoin. And then once the market turns, John, because your entry price is so low, it allows you to withstand all of the volatility that you're going to see throughout the duration of that 4-year cycle. Being able to withstand that volatility is really critical. Great question, Jim. John, this is a good one, John. Any thoughts on quantum computing stocks, the rebounds, such as IONQ and RGTI?
Well, we looked at quantums, right? We said that if you were in IONQ, we got a nice run out of this. If you didn't get stopped out on that sell-off, you got lucky, and now you know where your risk is. Let me just put a regular chart up here. You know where your risk is based on this one red candle. So as long as the market stays above there, then you're fine. The other thing I suggested is, maybe we count our blessings on some of these stocks, and that, if we did get stopped out for a profit, let's take that profit and maybe not reinvested it into like these, the D wave and this RGT, and that look at maybe looking for a diversified portfolio. We don't know which one of these ones is going to do it. And we talked about this, I think, last week. And IBM is actually one of the leaders in the quantum space. And so we looked at this, the Defiance Quantum ETF. Now, I'm not recommending this one. I'm sure there's probably some other quantum ETFs out here. But here's my point, was when we looked at this one, you get a nice basket of about 70 stocks, including companies like NVIDIA, but it's more of like an equal weighted ETF. So we don't have a large distortion towards one or two stocks. So plus you get all the quantum stocks. So to me right now, I don't have a position in any of these stocks, but if I wanted to play the quantum space and I wanted to be a little bit more conservative, I think the ETF would give you that more balance and then not have to worry about single stock risk. If you wanted to be aggressive, well, then you have to make your decision of which one you want, this D wave or this one or the IQ. But they all basically look to me in the same amount of risk and volatility.
So, John, we got this question. In selling equities, would you sell for profit or to return your initial equity invested?
Yes. So the way I usually trade is that my first level or my first target is going to be some type of a risk reward ratio. But that risk reward ratio is going to allow me to sell a small percentage of my stock position, or my whatever it is, where I recapture my initial risk, not necessarily the initial investment. That might be a little bit difficult. The initial risk. In other words, if I bought a $20 stock and I said I was willing to risk $2, if that stock went up to $22, that would be that initial risk. Maybe I might sell half of that position, so that the worst case scenario, if that stock comes back and stops me out, then I wouldn't lose any money. And then what I'll do from that point on is each level of target will be either a multiple of risk reward ratio, or then looking to start putting money in the bank. In other words, for profit. But, the other thing is, you want to let your winners run. So, that might be a scale out of smaller portion where I can continue to hold a position. But initially, my first target is usually where I recoup my initial risk, not the initial investment, but the initial risk. Yes.
John, do you think commercial real estate loan defaults could affect the performance of financial stocks this year?
I certainly think that it's a risk. I don't know if it's a large risk for the the majors, the Wall Street. I think the more the risk would be a sort of that middle level bank, or those regional banks that have a lot of exposure. And again, you'd have to look at, you have to go into their portfolio. Where is their exposure? I mean, there's a lot of interest and talk about what's going on in California, that some of the banks that are out there might be at some type of not only commercial risk, but also, residential risk as well. So, I think it depends on case by case, but I think it's more about looking at a regional bank that may be in a region that has, let's say a depressive office space, so to speak.
And actually, earlier this week or late last week, John, I shared a visual which actually highlighted which banks had the most exposure to commercial real estate loans. So I don't have it handy, guys, but if you're curious about that, go to our Twitter, go to our X account, and you can dig that up.
Do you don't have to recall which one of the ones that was at the top of the list?
I have one final question, John, and while you answer that, I'm going to try and get that answer for you.
Okay, cool.
All right, so here's the last one, John. Any thoughts on LNG producers?
Yeah, I still like them. Cheniere, there's a couple other ones that are coming online with. Again, if we see strong European demand and pricing, those ones are going to continue to do. I think they're just going to continue to do well. The LNG market around the world is getting tighter and tighter, even though production is increasing. So here is Cheniere, which is the leader, but there are other ones. We can look in that space. Let's look natural gas distribution. Yeah, you can look at this in terms of an alpha basis. It's been one of the better performing stocks. But look at the stock over, let's say, a 3-year period, right? So, right? Wow. I mean, this stock went from wrong one. LNG. There we go. Let's see, weekly, 3 years. All right, where are we at? We were at $100. I remember reading this stock at $75 at one point, and I ended up taking some profits. I'm upset that I'm actually out of this. But again, another, this is kind of that indication. Here's a stock that had been trading sideways for a while as the natural gas market was kind of trading sideways. But now we're seeing this incremental demand for natural gas, especially in the LNG space. And boy, it's really starting to take off again. So I've seen some analyst price targets on this one is somewhere between 300 and 3.25. So there is a lot of, I think, a potential. But again, look at this. Since its breakout of its range, back in 2021, this stock has gone on a 4,000%. Did you find it, Thomas?
I'm
Otherwise,
actually
I'm going.
I'm bringing up the visual, John. Give me 1 second.
Okay.
Let's see here. Okay, here we go.
Shoot me a name here.
All right, it's coming up here. So the top one, John, is actually J.P. Morgan.
Really?
Now, but like you were saying, John, a company like J.P. Morgan probably safe. I don't really think they're a going concern, regardless of what their exposure is to commercial real estate.
Right.
Bank of America. Here we go, John. Here's the visual, guys. So yeah, J.P. Morgan at the top, Bank of America, Citigroup, Wells Fargo, U.S. Bank Corp. Pretty big names there.
Yeah. And if you look at some of these that are on in that list that I just pulled up, I do remember Zion Bank was one of the ones they were worried about at 1.2, right?
Yeah, and that's at the bottom right. It looks like 51 billion exposure to commercial real estate loans.
Yeah, I think it's going to be the smaller banks that have a larger exposure than the big banks that have might have a large number exposure, but you have to look at it in a relationship to all of their assets. All right, good job on that. Pulling that one up at the last minute there, brother.
Yeah. And again, if you guys want this chart, go to our X account. I tweeted it on January 11th, so you guys can save it and check it out. So I think that'll do it for today's show. Again, guys, if you're watching on YouTube, John and I would be most grateful. Give the video a like, give it a thumbs up, give it a comment. Tell us what you like. Tell us about your favorite investment for the year. Whatever you want, we would be grateful to hear from you guys.
Yeah, I appreciate that, Thomas. You had a great show and have fun in the other side of the world. Until next time, folks, be well, manage your risk, and the good of all trading.